Namaskar Mandali. Today we are going to explore the exciting world of Ebita. But what is Ebita? You might ask. Let's find out together. Ebita, which stands for Earnings Before Interest, Taxes and Amortization, is a fancy term used by companies to understand how much money they are making from their core operations. But why is it important? And how is it different from gross margin? Let's dive in it. Imagine you have a little business selling delicious lemonade. You buy lemons, sugar, and cups, and then you sell the lemonade to your customers. The money you make from selling lemonade is your revenue. But what about the cost? You need to subtract the cost of lemons, sugar, cups from your revenue to find out how much profit you are making. This is where gross margin comes in. Gross margin helps you understand how much money you are making after subtracting only the direct costs associated with making your product or providing your services. It shows the profitability of your core operations without considering other expenses like salaries or rent. Now, let's take a step further. Running a business involves more than just direct costs. You also have other expenses like salaries for your employees, rent for your shop, and utility bills. These expenses are part of your operating costs and they affect your overall profitability. This is where EBITDA comes into play. EBITDA helps companies understand their profitability by considering not only the direct costs but also all the other operating expenses. It gives a broader view of how well a company is performing. So, while gross margin focuses on the direct cost of producing your product or providing services, EBITDA takes into account all the other operating expenses involved in running your business. It helps companies make better decisions and evaluate their overall performance. EBITDA is also used by investors and financial analysts to compare the performance of different companies in the same industry. Since EBITDA removes the impact of varying financial structures and tax rates, it provides a fair basis for comparison. To sum it up, EBITDA is an essential metric for companies to understand their profitability from core operations, considering all operating expenses. It helps businesses make informed decisions, evaluate their performance, and attract investors. So, whether you are running a lemonade stand or dreaming of becoming a business superstar, understanding EBITDA and gross margin will give you a solid foundation. And that wraps up our lesson on EBITDA and gross margin. Keep exploring, learning, and remember to squeeze every drop of knowledge out of life. See you next time.